Hello, I'm Amos. I'm proud to say that since June I've been the Chief Investment Strategist here at the CFB, overseeing the slightly more earthy investment matters within the team. I'm going to do an introduction and a look back at the year, and then you're going to hear from several of my colleagues in more detail about what we've done and delivered over the year. I'll wrap up and give you an outlook, and then we'd love to take your questions at the end. So if things occur to you, please type them in. We'll endeavour to address as many of them as we can at the end of the presentation. There's a long-standing urban myth that "may you live in interesting times" is the English translation of an old Chinese curse. No provenance has ever been found for this, and yet it continues to be widely quoted as an example of something that sounds positive and can be seen as quite negative. And the story of 2021 certainly fits the definition of interesting. The start of the year was quite bleak. Here in the UK, Christmas celebrations had been cancelled, unless you're in 10 Downing Street, apparently, leaving many of us away from loved ones and looking at another lockdown. High COVID infection rates led to high levels of hospitalisation, and many people were fearful for their health and that of their loved ones, but also for their livelihoods, as large parts of the economy remained shut and uncertainty remained high. In investment markets, we saw similar things. 2020 was marked by one of the shortest and sharpest bear markets ever seen in equity markets. Added to that, interest rates were slashed and a lot of companies cancelled dividends. Property companies saw rents reduced through the period of the acute phase of the pandemic. While a lot of these were sensible steps in times of uncertainty, it meant that for a lot of investors, they saw falling markets and falling income from their investment portfolios at the same time. Things improved during the year to quite a remarkable extent. COVID infections remain high. It does appear that both in the UK and worldwide, the vaccine programme has significantly reduced the linkage between infection and severe illness, Omicron variant notwithstanding. Schools and businesses are open again, and the hope is that by implementing less severe measures now, we can avoid further full lockdowns in the future. Debate continues over whether and when COVID-19 will go from a pandemic to endemic in the population, but the economy and people's lives, despite everything, are a lot more normal than they were this time last year. In investment markets, we saw similar things. As my colleagues will shortly demonstrate, investors in many asset classes have actually had a pretty good 2021, despite all the uncertainties. A lot of this was due to government actions. Well, I think we can all agree that the government has made a high number of errors of judgment in the last couple of years. Probably economically speaking, the most important thing that they did was the furlough scheme and other business support. And actually we saw this in lots of other countries as well. It wasn't just a UK thing, but that action by governments meant that when we did reopen following lockdowns, things were ready to go. People hadn't lost their homes, they hadn't lost their jobs, they had money in the bank. Companies, businesses were mothballed rather than closed down. And so when we were ready and able to reopen, the infrastructure was there ready to be fired up. And so we hadn't seen that collateral damage. And that was a really important thing, probably, again, despite all the things that we can challenge, the most important thing that they did to try and keep things going during this difficult period. In fact, it worked so well that we've started to see inflationary pressures in many areas. Unemployment is looking very low. Supply chains have been disrupted around the world, partly as a result of COVID, but there are a few extra special factors. We had the Ever Given, which got stuck in the Suez Canal and blocked supply chains in quite a practical way. The ongoing effects of Brexit, where we've put some barriers in place with some of our biggest trading partners in the UK. That's all gummed up global supply chains, and that's led to shortages of some items and price rises in others. There's also been a lot of talk this year about the climate emergency. Andrew and the others have highlighted how important this is to our ethical views, but there's also some very significant investment implications. It is clear that there are some quite difficult years ahead as we create a roadmap to a low carbon future and work out a lot of things, including how the burden is going to be shared between richer and poorer nations, countries at different stages of economic development, how we build the technology, how we transition from what we've got today, which is quite a fossil fuel heavy world, to one that's light. Now, what we see worldwide is a lot of consensus and effort towards getting there. The mechanisms still look a little more challenging. It's going to take us a while to get to where we want to, and there's going to be bumps in the road. So this year we saw some of that with, in the gas supply chain, for example, the combination of cold weather, less wind, low storage, are leading to rising gas prices, and as many of us saw here in the UK, soaring energy bills and so on. Petrol prices similarly hit their highest ever level in the UK as a surge of demand for oil in the post-COVID reopening pushed prices higher. And while in the long term we hope and expect the world will be less dependent on fossil fuels, the path isn't going to be smooth, and we probably are going to see these periodic spikes in demand over the coming years as we transition to that new world. I'm going to pause there and hand over to our fund managers to tell you in more detail what's actually happened in the last year. You're going to hear first from Miles Askew, our Head of Research, about our approach to managing equities and what's happened in equity markets over the years, and also how we've built a climate stewardship fund to protect wealth and also help the environment in the coming years. Miles, over to you. Thank you.
Thank you, Roz. Good morning, everybody. In this section, I'm going to talk about our approach to managing equity funds and adding value in an ethical way. If I can begin by quickly outlining the equity funds we manage under the Epworth umbrella. I'll also pick up where the CFB equity funds fit within that. We offer 3 equity funds with a combined market value of around £580 million. The biggest of these is the UK Equity Fund, followed by the Global Equity Fund. We were very proud to launch the Climate Stewardship Fund in 2020. It's a UK-focused fund, quite a bit different to our UK Equity Fund, in that it seeks to invest in companies that help with the transition to a low-carbon economy. In terms of those CFB equity funds, and I'm talking about the CFB UK Equity and the CFB Global Equity Fund, they have completed their transitions to being wholly invested in the Epworth equity funds. Let me cover our approach to constructing and managing equity funds. It all centres on a Christian ethical approach. The process begins with identifying stocks which are not consistent with our ethical policies. What does this mean? It means that in the UK market, we exclude 23% of the UK market. In the global equity market, we exclude 11%. There are some additional exclusions in the Climate Stewardship Fund. We identify the biggest emitters of greenhouse gas emissions. So having talked about the companies that we don't invest in, let me talk about the types of companies that we do invest in and the way that we construct portfolios. We build portfolios that have 3 identifiable characteristics. The first of these is positive ethical characteristics, or ESG characteristics. And that's either in respect of the products or services that they sell, something which improves the lives of people of all descriptions, or alternatively, they may not be the best companies from an ethical perspective, but they're on a very clear direction of travel. They're not in breach of our ethical policies. Perhaps they don't shine as much as other companies in the portfolio, but they're companies with a very clear mandate from the management, from the board of directors, to improve their ethical performance. Our equity funds are also broadly diversified. They capture exposure to all significant sectors of the market, apart from the ones that we exclude. Third, our equity funds. Fourth on the pie chart, third in terms of way we construct our portfolios, is our portfolios are focused on growth and quality. And we can conduct a lot of in-depth research to identify those sorts of companies. What do we mean by growth and quality? In practical terms, it's companies that we feel have excelled in their area of operation in the past and will continue to do so in the future. And typical characteristics that we see in these sorts of companies are exposure to long-term growth trends, a strong competitive position in their markets, and good management teams. And if I can provide a couple of examples of stocks that we have invested in. The first one is a company called FDM. This is a holding in a UK equity and climate stewardship funds. The company is focused on recruiting people and training them up as IT and business consultants. And we like it from a growth and quality angle because it's exposed to some good long-term growth trends, including things which touch us in our everyday lives, including cloud computing and cybersecurity. And we like it from an ethical perspective because perhaps more than any company that we invest in, this is a company with a very sharp focus on diversity and inclusion. Second company I wanted to talk about is Zebra Technologies. This is more of a technology company. It's listed in the United States and it's held within our global equity fund. It's a company which is focused on providing products and services that connect people with assets and data. And what does that do? Well, it helps massively to increase productivity and efficiency. In terms of the ethical aspect of this, because the company produces products, technical products, it's come from a position where it's quite a carbon intensive business. So we've been very encouraged and we've engaged with this company to talk about the actions and the commitments that this company is willing to make in terms of reducing carbon emissions. If I can talk about the funds in a bit more detail now, just touching briefly on each one, starting with the Epworth UK Equity Fund. As the name suggests, this is a fund which invests in UK equities, focus on income and long-term capital growth. Performance of the fund since inception has been good in comparison to the benchmark, and you can see that over on the right-hand side of the slide. In the past 12 months, the fund has delivered a total return after expenses of 20.8%, compared to 17.4% for the benchmark. Turning now to the Climate Stewardship Fund. This fund was launched in May 2020. It shares, as I mentioned earlier, it shares similarities with the Epworth UK Equity Fund, but it goes further on the issue of tackling the climate emergency. It applies a dividend yield, excluding the big oil and gas companies, does have a detrimental impact on dividends and distributions. We developed an approach which aims to compensate as much as possible the income that is lost. The fund has delivered a good return since it was launched, and over the past year was up 20.2% again in total return terms after fees, compared to 17.4% for the benchmark. Finishing off with the Epworth Global Equity Fund. When we had the idea of launching this particular fund, where we wanted to apply the same approach that we have got in UK equities, we were confident that we could identify companies that offered a good mixture of growth, quality, and positive ethical characteristics. And we've been successful in doing that. The fund has delivered a performance against its benchmark since inception, and in the past 12 months is up 23.3%, an incredibly strong return compared to 20.6% for the benchmark. Reflecting on the outperformance that you've seen across each of our equity funds, we feel that our stock picking approach has resulted in a number of the companies, more so than the market, having good exposure to certain growth trends, to being resilient through the pandemic, and crucially, are well placed to prosper once the pandemic is finished. Now, I've talked about the positive traits that we'd like to have evident in our portfolios. And this final slide looks at the carbon footprint of the equity funds compared to each fund's benchmark. And what you can see most evident is that the Climate Stewardship Fund has a carbon footprint that is 72% below the benchmark. I'd like to point out here that our climate change work goes beyond excluding the dirtiest companies. We consider ourselves to be thought leaders on the climate emergency, assessing and engaging extensively with the companies that we invest in. That wraps up my presentation. I'm going to pass you on to my colleague, Matt Jones, who is one of our fund managers. Matt has been with us for the past 7 years. He plays a key role in the management of our equity funds and also in our asset allocation process. But he is here today to talk to you about the great work that we're doing on the issue of tax justice.
Thank you, Miles. Good morning, everybody. Tax justice is an ethical issue that we feel we have been leading the investment industry on in recent years. We believe all companies should pay the right amount of tax transparently, in the right place, and at the right time in order to fully participate in a healthy society for all. We believe all companies have benefits from paying their tax. Tax pays for aspects of society that a business fundamentally needs to function, such as the education of its workforce and the transport infrastructure needed for labour, goods and services to be accessed and provided. I'm sure we can all recall recent headlines of large tax practices of large wealthy individuals and businesses. We believe that a failure to pay a fair share of tax by those able to do so undermines the fabric of our society, exacerbating levels of poverty and inequality. Even if we have reservations about how our governments might spend tax revenue, we are reminded of the teaching that was mentioned earlier of Jesus in Mark chapter 12, verse 17. Give back to Caesar what is Caesar's, and to God what is God's. But how can we as investors champion the cause of tax justice? Well, you may have come across the Fair Tax Mark. It's an independent certification that recognises UK-based companies and organisations that are demonstrating that they can pay the right amount of corporation tax in the right place and at the right time. There are currently more than 50 businesses that have been certified to date. These include brands such as Timpson and Lush and Richer Sounds, and it also includes some FTSE listed companies, including SSE, Marshalls PLC, as well as cooperatives, family businesses, and social enterprises. The process involves a rigorous and voluntary assessment of a company's tax policy and practices. Applicants are required to have a published tax policy, have a transparent ownership structure with publicly available accounts, and report on a country-by-country basis for each jurisdiction that they operate in. Once a company passes that assessment, it earns the right to carry the Fair Tax Mark. We chose to engage with this initiative in two ways. Firstly, by walking our own talk, so to speak. I'm delighted to say Epworth was the first and to date only UK asset manager to achieve the Fair Tax Mark accreditation last year. And the next step for us was then to engage on this issue with companies in which we are shareholders through our equity funds. Over the last 18 months, we have written to a number of businesses we hold in our UK equity portfolios, asking them to consider the accreditation. Of the 23 companies we've engaged with so far, we've received a response from 87% of them to date. House builder MJ Gleeson was the first company we spoke to on this issue, and we were delighted when it went on to achieve the accreditation as a result of our engagement, making it the first in its sector to make such a commitment. As many as 9 other companies have indicated that they are also looking into the accreditation, and we're monitoring their progress. There is a cost associated with the accreditation, and so in light of the difficult years that a number of businesses have faced, some were unable to make this commitment, but many of these firms have, to our pleasure, committed to improving their transparency on tax. If I may give one example, we contacted one of our investee companies called 10 Entertainment. It's one of the UK's leading operators of 10-pin bowling facilities in this country. For obvious reasons, that company has spent much of the last 2 years either shut or operating with significant capacity constraints. Given the near-term challenges to its finances that this has presented, the company was not able to justify seeking the Fair Tax Mark and the costs involved at present, but the company did nonetheless consider ways it could improve its tax transparency. And we were very pleased when it published its first tax policy on its website as a direct result of our engagement. The strong commitments to tax transparency by so many of the businesses that we have engaged with has raised our confidence that the companies we invest in take this issue seriously and do not seek to partake in the type of tax avoiding schemes that frequently grab the headlines. We also believe that this provides a clear example that investors can make a difference to the way companies operate in and engage with wider society. We will continue to engage on this point. For example, to date, most of our work has been with UK companies, as that is what the Fair Tax Mark is aimed at. But what about companies based abroad? There are more complexities involved in given the different tax regimes across different territories. But a couple of weeks ago, the Fair Tax Foundation launched an international accreditation that seeks to accommodate these challenges and recognise businesses outside of the UK. Whilst it's very early days for this initiative, at Epworth, we think this could be a useful tool to help us engage with companies held in our global equity fund over the coming years, complementing our existing strategy to vote against the share of companies where tax reporting is insufficiently transparent. So it's fair to say that whilst we've been delighted with our progress to date, there is plenty more work for us to do on the issue of tax justice. With that, it's time for me to introduce Harry Evans, another member of our investment team. Harry's been a member of the team for over 4 years and is now going to talk you through how we manage our fixed interest and cash funds. So over to you, Harry.
Thank you, Matt, for that kind introduction. Good morning, everyone. I'm Harry, also one of the fund managers at the CFB in Epworth, and today I'm going to talk you through fixed income and cash. So this presentation will cover the CFB and Epworth's fixed income funds, namely the Epworth Cash Plus Fund, as well as the bond fund. And I'll talk about the management of these funds in the context of markets over the past year and also possible scenarios to come. Our long-running cash fund, the Epworth Cash Plus Fund, formerly known to many of you as the Affirmative Deposit Fund, provides income on deposits, and meanwhile the bond funds provide capital growth as well as income, given the longer-term nature of the investing. Aside from growth, some of the things we see as key goals for these funds include, number one, security. You don't want to lose your money, and therefore we invest in high quality cash and bonds with banks with strong financials, corporates with resilient financials. You want strong diversification, So you want your money spread across a number of counterparties to reduce risk. And we've never had a default in the history of the Epworth Cash Plus Fund. And finally, I mentioned liquidity, as you want your money when you need it most, and we aim to make sure that that happens. And so basically, we're looking to provide the maximum returns for you in this asset class, whilst also being mindful of the security of your money. Now, you've heard a little bit about ethics in the presentations that we've already heard. And as in the equity funds mentioned by Miles, the corporate bond fund uses that same positive Christian ethical approach. Now, this has been reflected over the past year in purchases of, giving one such example, sustainable bonds as issued by the University College London. Now, this particular example will give funds to the university for investment in projects such as renewable energy and increasing access to education for underserved populations. And we're excited about the increasing prevalence of green and sustainability bond issuances and the ethical opportunity that this offers us. As we've already heard from Andrew and others, COP26 this year has meant that climate is very much at the forefront of public interest and investor interest. And so one thing we're proud to highlight, as well as in the equity funds, you can see on the slide that the Epworth Corporate Bond Fund had a carbon footprint 57% lower than its benchmark. So we're proud to see the low carbon footprint of our funds through our positive ethical approach. So I hope this gives you a sense of how we think about managing these funds and bringing together both investment insights and ethical issues. Now, turning to the story of the funds over the past year, as the UK economy has reopened in 2021 and growth has returned, investors have been very much in preference of higher risk, high return assets. You've already seen the impressive year that our equity funds have had. Now, market conditions have been somewhat more challenging in cash and bonds, as reflected by the margin in performance between our equity funds and our bond funds, and that's all quoted net of fees. And especially in the bond funds, we tend to invest in high quality bonds, which often fall behind as markets rally, as they have done in the past year, further impacting performance. If I go to the next slide, you'll see a chart of inflation over the last few years. Now, this is a factor in markets which has been particularly pertinent for the fixed income funds, and namely the Epworth Cash Plus Fund. You can see that on the right-hand side of the chart, inflation has reached its highest level since 2011. As we've all felt, prices have been rising, as has been previously highlighted by Roz. We've seen supply chain disruptions, labour shortages, and an energy crisis felt by many. Now, just to give a bit of context for the Epworth Cash Plus Fund, it derives its income from interest rates on deposits, and they're somewhat dependent on the Bank of England base interest rate. Now, a key remit of the Bank of England is price stability. So its Monetary Policy Committee looks to target an annual inflation rate of 2%. Now, as I'm sure you can see from the chart on the slide, that is currently 4.2% and is well above that 2% target. Therefore, in an attempt to address this high inflation, as we're seeing currently, the Bank of England have stated that a change of policy is likely to be imminent, and that will include interest rates being increased. As you can see from this chart, which shows a range of deposit rates from overnight rates to 12-month rates, rates fell off sharply at the onset of COVID-19 as the Bank of England looked to support the economy with cheap lending. Now, these rates stayed low throughout 2020 and throughout much of the last year. And this has been reflected by low rates offered by deposit funds across the market. However, the future is starting to look more positive, as you can see from the right-hand side of the chart, as rates have clearly begun rising. and this is an indication of the Bank of England's intention to increase interest rates. Now, I'm sure you've all noticed the slight dip as well in the last couple of months. It is worth noting that the Bank of England decided against increasing rates at its most recent meeting, largely due to caution over employment levels after the furlough scheme had been removed, and they wanted to see more data on this and did not want to prematurely remove economic support of low rates. However, a rise in the base interest rate of the Bank of England, although it's not yet been implemented, there is still hope for cash and bonds, especially if the Bank of England establish that Omicron might not be severe enough to require that continued economic support. This remains to be seen. So although we might not expect a rise in rates this year, the future is yet bright in 2022. Now I'll finish there, and I hope that gives you a good overview of both our approach and how we think things will evolve. And on that note, I'll hand back to Ros for an outlook of the year ahead.
Thank you, Harry. Thank you all for those presentations. And I hope that's given you a good understanding of how we bring this all together. There's a lot of talk, I think, about ethical investments these days, about various things, how you include them, the price of ethics. I hope what we've shown you in the last few presentations is that we don't think there is a price that needs to be paid. We think that if you bring together good insights into markets, good decision making, combined with clarity about what your values are and what you're trying to achieve, and then you use your voice, whether that be through activism or through voting, to try and move things forward, you can have a positive investment portfolio that also delivers really positive returns. And I'm really, really proud of what we've achieved in the last year or two in terms of those outcomes in this challenging time. So it also shows, frankly, what an extraordinary year we've had in those markets. You know, we don't usually see equity market returns of 20% and very rarely in years when you've had the level of disruption going on that we've had there. But no, I'm very proud of what we've achieved over that period of time. So thank you both for the presentations and for the returns to the team at the moment. I'm going to finish with a look forward, although I feel I should caveat it by saying I don't have a crystal ball and there's a big question mark over things at the moment, which of course is what will happen with COVID in the coming months and how governments will react in turn. The fight is not yet won. I think what we've seen in the last year is sort of periods where confidence was growing that this was nearer the end than the beginning, and then a bit of a setback. And to be honest, it doesn't seem as if we've finished that phase yet. So we do expect to see a little bit more uncertainty there. We hope that we won't see the same level of severity that we've seen before, either in terms of the levels of hospitalisations and deaths, but also in terms of the level of economic restriction necessary to control that, because that was a very challenging period, and I think it would be difficult for us to see us go through that again. So we're hopeful about that, but obviously nothing is certain at this point in time. Similarly, really, with the economy, broadly speaking, we're optimists, but with caveats. This year, 2021, has been interesting and extraordinary. We think from here the likely path is for inflation and for interest rates to rise. Equity markets are at reasonably high levels after the great returns that we've seen, but so are corporate earnings. So while we don't expect to see the same outsized level of returns from markets that we've seen this year, we still do expect to see positive returns there too. Property is another asset class that's also been astonishingly resilient. While what we've seen during this period and what we expect to see going forwards is a greater level of divergence between sectors. So offices, hotels, high streets are still suffering, but on the other hand, out of town warehousing, residential is doing extremely well. And actually yields from property funds are getting close to where they were in pre-pandemic levels as we see managers adjust to those sectors that are doing well. So we continue to have quite a positive outlook for the property market, again, despite some uncertainty and perhaps that greater level of divergence we would expect to see. Mentioned yields on property. The other thing I think that's happening as well is that in equity markets, whilst they're not quite there yet, we're seeing yields return slowly towards pre-pandemic levels. And so for many investors, even if we see volatility in the capital values of those asset classes, we would expect to see the income levels received from them moving back towards what we might have called a more normal level overall. Bonds. We're still somewhat cautious there. As Harry illustrated ably, they tend to suffer in an inflationary environment, and we have had already quite a prolonged period of low yields in bonds, so prices still look quite expensive. At the moment, we don't think that you necessarily get compensated for the risk of inflation by the yields that you're being offered in bonds. So whilst we can see some positive elements to that at the moment, that's not our preferred asset class overall. Cash, again, as Harry noted, is not giving you much in terms of return. What cash does give, though, is certainty. There's a price for that, which at the moment is not much return from it. But it does give you a sort of an anchor in terms of the volatility in the market. So where we see cash, what we think about that at the moment is people should be more thinking about what their cash needs are in the coming year and how they're going to meet them, and making sure that they've got sufficient there to balance that out overall. So overall, look, we think the outlook is moderately bright, with caveats. We're unlikely to see another year like 2021, hopefully on either the good or the bad sides, although uncertainties do remain. We're more positive about equities and properties than we are about bonds and cash. We think the biggest outstanding risks are inflation and government actions around that, but also any further setbacks in the ongoing fight against the coronavirus. What we will do, and what I hope we've demonstrated to you here, is that we'll always think about the long-term interests of our clients. We will strive to be good stewards of your assets, both to meet investment needs and to use our voice to drive change towards a better world wherever we can. And with that, I'm going to thank all my co-presenters and ask for your questions. Hopefully we'll have some come in over the course of the presentation. I'm going to answer the ones I can, and then anything very difficult I'm going to pass over to my colleagues. The first one we've got. We've just received an endowment of £70,000. Where would you invest the money today? As Nick noted before I presented, I was a consultant for 15 years, so I feel obligated to give a consultant's answer to that question, which is that it depends. And it depends on what you need to do with the money. I think, as we've indicated from our perspective, property and equities, in our view, are the asset classes most likely to give good long-term returns. We'll probably have a bias towards those for a longer-term investor. But if there was a need for the money in the short term, we would be looking at quite a high cash weighting potentially as well. So it really depends on what the needs are, what the use for that money is, whether you're looking to take income or achieve capital growth with it. But broadly speaking, thinking about what you're going to use it for when you need cash is going to be probably one of the biggest factors to think about in terms of that. I've got a question for Miles, actually, on the equity side. Miles, have any changes been made to the portfolio holdings in response to the pandemic?
Thank you, Ross. Some changes, yes. Nothing too extensive because of the sort of companies that we seek to invest in, quality companies with good growth characteristics. They've not been unaffected by the pandemic, but they have been resilient. We did undertake a significant body of work, and it had to take place in a very short space of time when the pandemic struck, and stock market weakened incredibly quickly and significantly. And the work that we did was to take a look at the companies that we have got. Are there any companies which have a lot of financial leverage? Is there a lot of debt? Have they got very high cost bases which they can't do much about? And what about demand for their goods and services? Every company has been impacted. Some companies, such as Peloton, for example, have been impacted positively. So that resulted in us exiting a couple of stocks. And probably the sector which we were most concerned about was the travel industry, for obvious reasons. It's not just about what we sold in the pandemic. The weakness that we saw in stock markets created some really exciting opportunities in good quality companies at prices that we hadn't seen for the past decade. So there were some great opportunities to purchase some really good quality companies.
Thank you, Miles. I've got one that I'll respond to here. So who creates the benchmarks you refer to? It's a good question. We tend to use broad market indices for the benchmarks. So they would be things like the FTSE All Share or the FTSE All World Index for equities, the iBoxx Corporate Index for bonds. Basically, we use all standard indices for most of those. We have in the past, and we do work with some clients on calculating ethically adjusted indices. It's an interesting question because as you start to remove sectors from the universe, there's a question about whether we should measure against those as well as the broader market indices, particularly if you look at something like the UK equity market, where oil and gas companies make up quite a large proportion of the index. What our preference is to try and calculate that impact, but also to utilise the broader index as well, because as I referenced before, I think at some points we'll see things like increases in oil and gas prices, and that will create a challenge for us in performance terms. But at other times, we think we'll see those companies struggle performance-wise, and that's something that we think is helpful for people to see. So we'd like to compare against the full opportunity set, which is the broader index, but we also think it's worth trying to calculate over time how our ethical decisions have impacted that, and whether we're making good decisions on top of the ethics, or whether the ethics themselves are helping us to get there. So thank you for that question. I've got another one for Harry. I think, Harry, that you answered this during your presentation anyway, but just to confirm this one. With regards to the diversification that you mentioned, have you had any issues with counterparties in the deposit fund recently?
Well, just as a start, we tend to invest only in banks that are rated well, so they've got a strong credit rating based on strong financials. Now, in the last couple of years, there are a couple of good examples where we've taken precautions on banks which are rated highly enough, but may have faced trouble. So, for example, Credit Suisse was involved in the Archegos scandal and the Greensill fallout as well. So in that particular case, we imposed a lending limit restriction, so we weren't overexposed to that particular bank. But it is worth highlighting again that we've not had a default in the Epworth Cash Plus Fund in its whole life. And throughout that period, you can think of various banks that have gone under. Barings Bank, in the financial crisis, we saw Lehman Brothers, the building societies, Icelandic banks. So we've weathered all of that and not had a single default, which kind of highlights the merit of not only targeting highly credited counterparties, but also spreading across these highly credited counterparties.
Thank you. I don't have any more questions coming in at the moment. So with that, I'm going to thank you all very much for your participation. I hope it's been both interesting and useful. And I'm going to hand back to Nick to wrap up the rest of the conference. Thank you very much.